Hey guys and gals, Kevin Bupp here. I've got some very exciting news I'd like to share with you before we jump into today's show. Now, after closing on Fund 4's first acquisition of a $50 million institutional grade mobile home park, we're adding a second irreplaceable piece of real estate to the portfolio, and it's coming into the fund with over $1.5 million of built in equity for our investors day one. Now, when I say irreplaceable, I really do mean it. I mean, this is an affordable yet high-end waterfront mobile home park located in the Columbus, Ohio market. Quite literally, every single mobile home on this property is right on the lake, each with its very own personal boat dock, meaning a very high demand for affordable weekend getaway options, as well as year-round housing for working Americans. This is a true unicorn of a property, and you will not see another one like this come around again. It really is a one of a kind. A few other aspects worth noting. This park is producing stable and predictable cash flow day one. We're acquiring it with an excellent in-place Freddie Mac loan at a 3.3% interest rate for the next 8.5 years. This also includes a period of interest-only payments. Again, the simple supply and demand dynamics here are enough to get excited about. This is affordable lakefront real estate for both the working American families as well as folks looking to lock down a reasonably priced waterfront escape. Don't let this opportunity pass you by. Visit investwithsunrise.com to register for our webinar and learn about all the wonderful aspects of this property going into Fund 4. Again, that's investwithsunrise.com. Now, let's get on to the show. Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Our guest for this week's show is real estate and investment expert, Zach Lemaster. Now, Zach is a seasoned real estate investor that has accumulated a large portfolio of rental properties across multiple different markets, including single-family properties, multifamily, commercial, and also new construction. Now, Zach started his real estate investment journey while working as an optometrist and captain for the U.S. Air Force. The cash flow from his real estate investments eventually allowed him to retire early from his military career in medicine to be a professional investor by strategically investing in markets that maximize cash flow, appreciation, and equity. Now, we had Zach on the show roughly 2 years back, and so I wanted to bring him back on to just get an update on what's the latest and greatest with him and his business. And as you guys know, a lot has changed over the last 2 years. So excited to have Zach back here on the show. So with that, guys, welcome Zach Lemaster. My friend, how you doing today?
Hey, Kevin, it's good to chat again. I can't believe 2 years has gone by so quickly, but
I know, it's like that.
yeah, lots has happened over the past 2 years. But yeah, appreciate you having me back on.
Yeah, it's funny. I feel like the last 4 years, I mean, once you like factor in the COVID, the pandemic and all that, I feel like just the last 4 years have been somewhat of a blur, and hopefully all the good memories have stuck here, and some of the maybe the bad ones just move on from. But it's been a fast years for sure, and so excited to have you back here, and learn about what's going on with you guys. And so, for those that aren't familiar with this act, that don't know your story, don't know what it is you do outside of that brief introduction that I provide you, maybe take a few minutes and just tell us a little bit more about yourself.
Yeah, I'd be happy to. So I'm the founder and owner of Rent to Retirement. We're the nation's leading turnkey investment company, and so we assist investors in building their individual portfolio. This is mainly single family and small multifamily new construction projects in growth markets where we handle everything for them, from finding a property that fits their goals, leasing and managing it for them so they can build their individual portfolio. But like many people in the real estate space that are kind of full-time, Kevin, I started my career path doing nothing to do with real estate. So as you mentioned in the intro, my wife and I are both optometrists by education. I was on scholarship with the Air Force, so I was commissioned to the captain to the Air Force, and I practiced optometry for 7 years there, and that's where I started investing. I mean, a simple house hack was my first house, right? And this was close to 15 years ago at this point, but bought a house, lived in half, rented out the other half, fell in love with real estate because I thought, what a cool concept. I can buy a property. I used a VA loan, so I put no money down on a property. I was able to acquire an asset with really virtually no money down, where I was living rent-free. And I also was able to own an asset that grew in value over time. I got tax benefits, et cetera. And I just thought, what a cool concept. And so I went out and bought more, right? I bought more duplexes and I started my local market. But there's a pivotal moment in our investing trajectory, my wife and I, where we started to learn how to invest strategically out of state. I was stationed in North Dakota at the time. It was an okay cash flow market, not a great appreciation market. But, we essentially built a strategy around identifying what markets throughout the country had the best returns, both in cash flow. The growth markets for appreciation had property opportunities that were more congruent with our goals to allow us to scale quicker. And that eventually allowed us to strategically retire from our career paths in healthcare through investing out of state. And that didn't happen overnight. And we hit many challenges, but I mean, that really changed the trajectory of our investing. And so that caught a lot of people's attention, our friends and family and colleagues, where we were having success with real estate to the point we were able to replace our active income. And they basically approached us and said, "Hey, can like, will you invest with you? Can you help us? Yeah, we don't necessarily want to be landlords. We don't know how to start investing or invest out of state." And so that was really the birthplace of rent to retirement. So fast forward where we're at today. I mean, we're helping people build their individual portfolios, following the same path that we did, investing across multiple states. And so we work in the Midwest and Southeast. We did just under 1,000 doors last year, mainly in the build to rent space, and helping a lot of investors, accomplish their financial goals. So it's
Well,
a
that's
quick intro on
fantastic.
myself. Yeah.
Yeah, no, that's awesome. A thousand transactions last year alone. That's fantastic. That's a lot of volume. That's a great deal of volume just to the mechanics of it, because you guys are doing just correct me if I'm wrong. Most of what you're doing are one-offs, right? Like you're doing a lot of new construction, build to rent. I know that you also have turnkey opportunities that are just fully rehab properties. But I mean, 1,000, that's a lot. I mean, the mechanics that go on behind the scenes, I can only imagine what that looks like.
Well, it's been a nightmare in the construction industry over the past few
I
years,
bet.
as you well know. But yeah, I mean, we have, that's why we like working with investors, just as you do as well. But we can kind of reverse engineer our business model, where we know that if we're operating in an area that has demand and it's a growing area and has an undersupply of housing. I know you know this, but there's a deficit of 7.2 million houses in the U.S. And a lot of those are geographically centered around the Southeast. So as long as we can be consistently providing housing opportunities in an area where there's an undersupply of housing, we can keep those houses rented. We can offer good returns for investors, and investors are coming back to grow their portfolio, right? Versus
Mhm.
building on and selling to a retail market where someone buys a house once every 7 to 8 years. Investors are looking to grow their portfolio and scale over time. And so we can kind of reverse engineer the business model. That's what I think has allowed us to do well with the varying construction industry over the past few years.
No, that's great. I'd love to get an update from you about the construction industry and just what it looks like. But before we go there, just curious as to, and I do not follow, the conventional loan space as it relates to like single family investment properties, but just curious as to what type of loan products are available out there today for the investor that's looking to build his investment portfolio, that wants to do it with turnkey properties like the ones that you provide. Are there limitations based on getting to a certain number? After that, they've got to go, move away from conventional financing. Is it anyway? Just what are the options? Because back when I owned single family properties, it's been more than 15 years now. The landscape was very different, right? Like there weren't that many options available. You had to get really creative in order to have a significant portfolio, mostly just private money, in order to build a larger portfolio. But I know that options are much greater today, and there's more available. So could you speak to that, please?
Certainly, most of our investors are buying with just conventional loans, your Fannie Mae, Freddie
Okay.
Mac loans. We usually, our typical client avatar is someone who is a brand new investor. They're looking for an easy way to start or scale their portfolio, because we assist people versus like the syndication space. We're helping people like buy their own properties, right? So they're 100% the owner of the
Yeah.
asset. We're not pooling money. We're helping people actually own their own real estate portfolio strategically and build a business plan around that. So most people are starting their investment journey, or these could be people that live in expensive areas where their local real estate doesn't make sense, or high paid professionals where they want to own real estate, but they don't want to be a property manager, right?
Hmm.
We've all, been there before.
The
But
dirty work.
yeah, what are they? It's tenants, toilets, and trash, or whatever the T's are. Yeah. So we do that for them so they can enjoy the financial upside of property ownership without dealing with the day to day. But yeah, most of our investors being in that position are using conventional financing. And so that's your Fannie Mae, Freddie Mac loans, 20 to 25% down on a 30-year fixed loan. That's great. But to your point, I mean, not everyone qualifies for that. If you're self-employed, there's very strict qualification criteria. You can have 10 loans under your own name at any given point in time. If you and a spouse are investing, in theory, you could have 20, both be on title, but financed separately if you can qualify. But we do, like, one thing we pride ourselves in is that we offer a lot of different creative financing options, and we really scour the market to identify what are the different lending options to people. And there's some really unique products that I think most investors that are building their own portfolio really or unaware of. For example, and these are things that have developed over the past 4 or 5 years that I think are really strategic, especially with where interest rates are right now. It's a little bit more of a challenge to underwrite deals to still get them to be positive cash flow. But there's some local credit unions we work with where hey, they have a portfolio loan product, so it's not a conventional Fannie Mae Freddie Mac loan. It's a portfolio product that they underwrite internally. Um, they still qualify you for this, but they can leverage up to 95% of the loan on up to 5 investment properties if you qualify for. So that's just one example. We also offer seller financing options for people where they could potentially come to the table with 0% down. I mean, of course, these are all unique scenarios that make sense
Mhm.
that you need to determine if this makes sense for you. But we're doing a lot of creative things as well in the build to rent space where, we may even come in and cover part of your down payment or, find a DSCR lender that makes sense for you if you maximize your conventional loans or you need additional loan resources or things like that. So it's just about finding the right financing opportunity and then matching it with the investor's goals based on what they're trying to accomplish.
Yeah, and so on the conventional route, with Fannie or Freddie, are they solely looking at the borrower's income, or do they now also take in consideration actually some of the income from the property itself when viewing it as an investment property?
On investment properties, they will consider, and this is a misconception out there that a lot of people are confused on. So I'm glad that you brought this up. So on a conventional loan, say you're putting 20% down buying a single family house, for example, it could be a $250,000 house in the Southeast in Florida, Texas, Alabama, whatever the case is, that might rent out for, call it $2,200 a month or something like that. So you can still cash flow with that type of asset. The bank will actually look at they'll take the income into consideration to offset your DTI immediately, and it doesn't even need to be rented actually. And so that's something that's changed in the lending space over time. People think that sometimes they need like a 6 month seasoning period or things like that. They have a calculation that they'll use. Usually, I think it's around 70% of the rent that they're able to offset the debt. And so that does help people scale quicker using conventional financing. But you can count the income from the property, even if it's not rented, when you're buying that property, even if it's your first deal. And so, certain things like that certainly help.
Yeah. And I know those the DSCR loans. I mean, that's something that's fairly new. I mean, meaning that probably 5, 6 years that it's been out in the marketplace. I mean, is that really that? And like speaking to like credit unions, they have a portfolio product. I mean, and once you get to that 10 as an individual on the conventional side, like that's you pretty much have to look elsewhere, correct? If you want to continue building that single family home portfolio.
Yeah, there's two thought processes on that, and there's different strategies we work with people on over time. 2, 3 years ago when interest rates were all-time low, most people were like, "Yeah, that's your golden ticket, right? Your conventional loan that you absolutely want to use." With where interest rates are right now, like there's a lot of different competitive loan products out there that may make more sense for you, like ARM products, right? We can get a 3.99% interest rate on a 10-year ARM that's still amortized for 30 years. And so
Wow.
there's unique things out there, and we're paying points for that. We're buying the rate down for the investor, but it's still achievable, and that's the lowest rate we've seen for probably close to 3 years. But um, yeah, to answer your question, I mean, the DSCR products that just depends if it makes sense for you. If you can't qualify for that conventional loan product, and the DSCR is debt service coverage ratio, so it's based more on the actual property performance itself. But the two thoughts are, if you want to use your conventional loans and that makes sense for you, and you get to the point where you're scaling and you have 10 or with a spouse 20 of those, either you have to start looking for other loan products to use, or you can also, if you've had a few properties, most people are buying 10 or 20 immediately, they're doing it over time. And so you can always like consolidate and refinance a
Yeah.
certain level of those under like a portfolio loan to open up
Mhm.
more of those conventional spots. But man, right now we're seeing a lot of people that, we're just weighing all the options, right? Here's your conventional products. Here's your portfolio loans and DSCR loans. Here's maybe a non-recourse loan if you're doing it through like a self-directed IRA or retirement account. Like, what are the options and what makes the most sense for you? So we actually see a lot of people buying with non-conventional products right now.
Yeah, no, that makes sense. Yeah, I didn't even give that consideration originally. Yeah, if you hit your max of 10 or max of 20, if you're a married individual, just do a portfolio loan and recap the entire portfolio and open up the space so you can go get more conventional loans if it makes sense. If that's the best route to go, right? So
Yep.
no, fantastic. So you mentioned earlier on, just we talked about like maybe some of the changes over the last 2 years. You guys are heavy in the construction space, right? Like it was very difficult. I mean, we've got properties all across the board, and while we're not in the construction industry, we always have a significant amount of construction projects happening in all our respective communities, whether it be bringing new homes in, doing major, CapEx projects, and everything in between that. And we struggled a great deal. I'd say up until probably about a year ago, we struggled a great deal finding decent labor anywhere, no matter what we were willing to pay. I mean, talk about how you guys and our business relies upon a lot of those projects, but it's not the lifeblood. And so, like, we definitely, had to delay certain projects, maybe kick the can for a year. Like, hey, we were going to do this road improvement project, but we literally we can't find the necessary vendors, or they're booked out a year and a half, what have you. Um, and so it didn't necessarily have a negative impact on our business. It just slowed the progression of maybe some of the projects down. But your business is heavily reliant upon construction. Talk about how you guys manage through some of those challenging times, and then I guess what does it look like today? Has the landscape changed, where now you've got good quality laborers? The band's back. Like, you're finding folks that want to come work and get the job done. So just talk us through that a little bit, if you would.
Well, certainly it's been an evolution over time. So labor is just one challenge point for sure. Obviously there's varying degrees of construction material costs, and
Yeah.
permitting changes has been a big thing recently. Where as I know you're heavily invested in Florida, as we are as well, and it's just kind of been a nightmare. So our business has basically evolved over the time, where we've actually started to partner and leverage um, national builders to partner with them,
Hmm.
to offer products to our investors. So there's really what our business looks like today is there's and to the client, it's the same thing. It's offering a turnkey property that's newly built, leased, and managed for them in a growing market. But where that inventory is sourced could be a number of different ways. And so this is how our business has evolved: is one, either like we do all the project with development and building ground up, but that's actually probably a very small percentage of the deals that we do at this point in
Okay.
time. The other thing we do, because we have a volume play, we have thousands of investors that are buying properties every single month. So we're able to go to some of these national builders. Some of them are specifically in the build to rent space. Some of them are more national retail builders, like D.R. Horton, who's the largest national builder, or LGI Homes, or whatever the case is. We're able to go to them and actually negotiate wholesale type of pricing with them, because we do a volume play. So like an institutional buyer would, when they come in, they're buying
Hmm.
hundreds or thousands of houses at a time. They're obviously negotiating price points below market value and coming in and getting this wholesale type of pricing. We're able to essentially accomplish the same thing. And then we pass those savings on to the individual investor that they couldn't access on their own. And so we can go to a DR Horton or LGR, or some of these national builders, and pretty much cherry pick and identify the construction that the properties are already done, they're already newly built in the markets that we have established managerial teams in, that we know will cash flow, and are in markets that we want to focus on. And then we're able to pass on those wholesale discounts, sometimes 20% below market value on a new construction house, where someone's coming into immediate equity, and actually lease and manage that for someone, so they can come into an opportunity that maybe a different builder built, but we know we have all the teams and systems in that area, and we can negotiate those deals. So that's actually the majority of the construction that we do now.
Is that predominantly a result of the fact that home sales have slowed quite a bit over the last year and a half with the rate increases, or is that now, given the just the guess the build to rent space didn't really have its own identity 5, 6, 7 years ago, right? Now it does, and all the big builders are they're active in space, are really well aware of it. So is that, or is that, like, with these national builders, do they actually have a dedicated part of their business now? It's solely geared around working with groups like yours and larger institutional buyers that are going to be buying batches of 300, 500,000, multiple thousands of homes. Just curious.
Yeah, they certainly have become more open to the idea. I will
Okay.
say that we've been a pioneer in the space to be the first to the gates, where we're bringing individual investors and not necessarily like a fund or an institutional type of buyer. And that's taken a lot of negotiation with the builders, but they're certainly more receptive to it now. And we've seen some of these builders actually develop a wholesale division, where they're predominantly a retail type of builder. Now they understand, well, hey, if there's a demand for investors to buy these properties, and these are A-class areas, that they traditionally, their exit plan was to sell all retail, and that, the stagnation in the market, now they're sitting on inventory and construction loans that are, going through changes and things like that. So that's, I think, opened up the door to us to be able to come in and negotiate that. But some builders have started to develop their wholesale division where, yeah, they can carve out a portion to sell to an institutional buyer. But it's kind of this perfect storm where I think what has allowed us to get a foot in the door and have this opportunity is, to your point, sales have slowed. They've stagnated
Yeah.
in some areas. On the retail side, the investor side is still booming. Institutional buyers, even if they already worked with an institutional buyers have slowed down a little bit. Now we've
Mhm.
all heard news about Blackstone coming back in to buy large amounts of build to rent, but like over the past couple of years, there's been slower institutional capital, and so with our sales have not slowed down with investors because we know the individual investor, regardless of where interest rates at, they're still buying as long as they can make the cash flow make sense and you get the tax benefits and things like that. So, yeah, I mean, there's an evolution in the build to rent space for sure in the investor world.
And what's the typical formula look like? I mean, rent to value ratio. I mean, is that what you use, or is there another metric that you guys use to determine, what that buy box is, and whether or not a deal or a particular, I guess, location might make sense?
First of all, we want to be in an area that can feel confident someone's going to have sustainability. So it's all supply and demand. And as we've talked about a lot, the South has a huge discrepancy between supply and demand and a huge undersupply of housing. So first and foremost, we want to be in areas that we know will be strong rental markets and have growth potential over time. We're seeing about a 6% year after year increase in our rents, which is almost double the national average. And these are just
Mhm.
because these are areas where there's demand. So we want to be intentional on where we choose. We also want to be below the national house price point, which is above or below the $400,000 point at any given point in time. We're mainly focusing on houses in that $250,000 to $300,000 price point. So we know that brings the highest demand for tenants and homeowners. Rent to price ratio, that's not a metric we normally follow because there's so many other metrics that you have to look at with that, with
Yeah.
like taxes and the lending structure. We want to meet an 8% cash on cash return, assuming
Got it.
someone's using a 20% down conventional loan, being below the median house price point in an area that has diverse economy and a growing economy. And that's just where we've been positioned for success year after year.
Okay, good deal. And is that both brand new and existing homes, or is there a difference as far as like?
Everything we've talked about has been mainly new construction. So these are
Okay,
built to rent,
got
single
it.
and small multi. We do some rehab stuff in the Midwest still. That's about 10% of what we do. And those are like
Okay.
lower price points, 120, 130, where it's a lower barrier of entry to buy
Isn't that
those.
crazy that there's still markets in this country where you could buy a home, probably a 2 or 3 bedroom home, one that's probably been recently remodeled for $100,000. That's mind boggling.
Yeah, yeah, that's a down payment in most people's
Yeah.
market. And those are good cash flow markets. They're not great appreciation markets, but hey, it depends on what your goals are. And if you got 30K to invest or 25K and you just want a solid Midwestern cash flow property that's not going to be in a really volatile market, that may be the right play for you. It just all depends.
What's your favorite part of Florida right now? Where are you guys spending most of your time?
Well, if we talked 6 months ago or a year ago, I would have said Southwest. So we do a lot in Fort Myers and
Hmm.
Cape Coral and Tampa, and that's still a growing market. I think there's a lot of other people that have jumped into that area, and so we've seen
Yeah.
some fluctuation in rents. We also one thing we try to focus on is what we call like secondary markets, and these would be areas adjacent to your large metro areas. So like one area we're heavily invested in is Polk County, so just
Yep.
like
Lakeland.
southwest of Orlando, Poinciana. We're doing a lot of construction there. And, if we can be within 30 minutes of a commute to like downtown Orlando or something like that, I mean, I think you're well positioned because there's a lot. I mean, so just for affordability purposes, people are moving to those areas. So,
Yeah, no, that whole I-4 corridor is just is exploding. It always used to be. I've been down here for for a little over 20 years now, and it was basically it was no man's land between Tampa and Orlando. Polk County, you had Lakeland, but still, even then, Lakeland was it just it wasn't a booming market. It wasn't a lot happening there. And then the rest of Polk County, there definitely wasn't much happening at all. Right, it's just rural for the most part. But it's definitely changed in a significant way over the last 10 years. More specifically, the last 5 years. It's just absolutely booming. So
yeah.
no, I think you're in the right market. I think you're in the right area, and you're in that. Like literally, you've got the Orlando being the primary driver, but then at the end of the day, you're still only an hour and 15 minutes away from Tampa. So you've got two major cities in a fairly short driving distance. You
Yeah,
can't really go wrong
absolutely.
there. And plus, on top of that, a lot of folks that move to Florida, if they're coming from the Northeast or the Midwest, it's just I think a lot of folks that move here that are transplants here, they're used to slightly longer drives, like to their commute or wherever they're moving from, like driving a half an hour, 30, 40 minutes. it just isn't a big deal. And so, with that being said, you can get to, I mean, there's a lot of employment opportunities in that surrounding 30 to 40-minute radius. So,
Well, it's yeah,
uh,
that's interesting, Kevin, because you think about you know, 45-minute commute in LA to go 2 miles is you know, much the geographic distance may not matter so much, but certainly
that's
people are,
right.
you know, that's nothing to travel.
That's right. Let's talk about your company. Last couple of years, or maybe we can hone in on the last 12 months. And it sounds like you guys have had just a lot of growth and a lot of major but yet positive changes within the organization. Maybe give us some insights. Peek behind the behind the curtain as to what's going on internally. What are some positive changes that you guys have made here over the last year that will help you continue in your growth trajectory?
Yeah, I think that the what we've already talked about a lot of just focusing on new construction. I mean, that's been a position of ours over the past 3 years to make that transition because historically, you know, when we started 10 years ago or whatever, we were looking at mainly focusing on just rehabbing houses in the Midwest, and that's kind of what people think about when they hear turnkey, you know. And so
Hmm.
I very much think of us more in the build to rent space than anything. And there's a lot of emerging markets right now where there's a huge undersupply of housing, and I'm just loving it. Plus, I think on the investor side, owning a house that's a brand new built house, I mean, that's going to attract quality tenants. We've seen just a lot more predictability, better growth potential for investors
Hmm.
over time. You know, so I think just that change in general has allowed us to really open up some new interesting investment markets and provide more predictable returns for investors. You know, they're not having to deal with people moving every 1 to 2 years and maintenance issues. They're seeing higher growth. Albeit the home prices are higher in new construction, you know what I
Hmm.
mean? So it comes with the territory, but I think it's the right place to be. And then partnering with some of the builders that I mentioned, I mean, that's just an immediate way that we can tap into a significant amount of markets where it would take us years to develop our own internal team there, and also negotiate deals that the average investor wouldn't be able to on their own. So those are all been really positive changes. We're all dealing with the same thing. I mean, with where the debt is and things like that. But I mean, we've always been, I guess, prided ourselves in being creative to find opportunities regardless of what's going on in the market. You know, just like some of those creative financing options that I talked about where people
Yeah.
can buy with little or no money down. And we're just always trying to find creative ways to serve the clients and allow them to scale their portfolio. And I think we've done well because of that and have a lot of repeat business. So, you know, we're excited. We'll see what 2024 is an interesting year. We'll see where things are headed, but we're excited.
So painting that picture for 5 years down the road, what does the organization look like at that point in time, from where you're at today to again 5 year mark? Company looks the same, but just more transactional volume on an annual basis, going down different paths. Are there other areas of interest outside the build to rent that you see an opportunity? And just curious as to what that crystal ball might look like.
Yeah, I mean, our goal, our mission statement is to make the best deals across the country accessible to everyone,
Mhm.
and do this in a turnkey way where we can handle everything for you. So regardless of where you're located or your investor, your experience level, you're able to either start or scale your portfolio in a systematic approach and use some of these creative financing and tax strategies. So we're going to stay true to that and consistently always be identifying the new up and coming markets where there's opportunity. And I think there's going to be a lot of opportunity internally. I would certainly like to offer more services to our clients internally. So, you know, we have great real estate attorneys and CPAs that can set up LLC structures or help them, you know, maximize their tax structures. If you're doing something creative like, you know, doing cost segregation or something like that, and maybe we'll bring some of those things in house as well. But we have great referral networks for people right now. I mean, one thing over this past year that I think has been really interesting for people is really focusing on the tax side. And so we have some high income earners that are brand new real estate investors where, you know, maybe they wouldn't qualify for real estate professional status if they were
Hmm.
interested to do something like a cost segregation study. Well, now we have an option. We're breaking, you know, into the short term space and the midterm rental space, which you could take a house that is producing positioned in the right market where you may get an 8% cash on cash return from a long-term rental, but you can get a 12 or 15% from doing a mid or short-term rental on that same property just because of the demand in that area. And in addition to that, we have a program where we help people potentially self-manage that short-term rental for the first year, so they can take that accelerated depreciation and that short-term loophole and still maximize their tax benefits. And then after the first year, like, they can turn it over to us and we'll manage it, or they can continue to self-manage it because we provide them all the tools and resources to do that. So just breaking into, some more spaces outside of just long-term rentals and using some unique tax strategies to help people. I think that's on the agenda for the next few years as well.
I love that. And midterm rental, is that like minimum 1 month? Is that
Yeah,
how that's
30 to 90
classified?
days. Yeah, these would
Okay.
be traveling. I mean, when you hear midterm rental, people think about traveling nurses
Yeah.
immediately, but man, there's also like insurance providers. That's our biggest client, actually, to place people in housing on a short-term basis. And sometimes they lease stuff 3 times what the long-term rate would be, and they sign leases for a year, and someone may only need a house for 2 or 3 months or something like that. So that's been a unique space we've been able to jump into as well. But yeah, typically, rotational type of occupations.
Got it. Got it. Flipping real quick, just a question on the property management side, more as it relates to these new construction turnkey rentals. What have you guys found to be the typical retention rate for occupants of these homes? I mean, is it longer than your standard A-class apartment facility, or what's the data show?
Well, I'm not quite sure, since we're not in the apartment space. You'd be able to answer this more so on what the typical occupancy is. But on the single family side, in that, say, call it $300,000 price point, where the rent is probably $2,400 to $2,500 a month. So
Hmm.
you are attracting a more, I think, stable and attractive tenant. Our average occupancy time is about 3 years on that.
Wow.
So I think that helps to reduce your vacancy and increase your income. I could compare that to, say, our Midwestern assets, where, on that $120,000 house or something like that, where the average person is staying like 18 months. So it's almost double the occupancy per time for us on the new construction assets.
Yeah, I'm assuming a lot of that has to do with, number one, like the quality of the tenant base that you're getting, right, and that higher price point, right? Like, it's more again, not to throw any demographic under the bus, but white collar versus blue collar, a little bit more maybe stability on their income, more flexibility of them, just literally work from home, not having to commute back and forth to a job, or that one unexpected expense of a tire going out in their car is not going to completely derail them or make them unable to pay their rent, right? So it's just a different quality demographic that you're serving. But on top of that, I would think it also has to do with the newness factor, right? Like, just literally everything is brand new. It's modern. You got higher ceilings probably most of the times. You got more of an open concept layout than what you might find in some of those older Midwestern homes. I mean, is that an accurate statement?
100%. We're seeing people, I mean, also families. I mean, people want their space, and we're seeing, young families getting into these homes where they want to be in an area for a few years, right? They're not in
Right.
transition. This isn't temporary housing for them. Certainly at the higher rent rates for these, they have more established occupations, often dual income type
Hmm.
families, and just new construction. To your point, yes, everyone wants new. You attract the best quality tenants. I think you attract the most tenants. But also just building in these areas, in demand areas. Builders, ourselves included, are not arbitrarily building in locations where there's not demand. So we're attending city planning meetings and seeing where, new transportation and jobs are being developed, and focusing on building in those areas to serve that demand. And I think that's done very well for us, leasing properties quickly and keeping them leased.
Yeah, no, good deal. Zach, for those that have an interest in learning a little bit more about your company and maybe some of the opportunities that you guys have, where's the best place to track you down and get more info?
We always want to drive people to the website, Kevin. So that's
Mhm.
renttoretirement.com, renttoretirement.com. If you're listening in the car, you can text REI to 33777. That's REI to 33777. We got our podcast, our YouTube channel. We put out a lot of information, just market data. If you're interested in possibly some turnkey rentals, or if you're just interested in, for learning about some of these financing options we have, we'd be happy to share those resources, market data. We don't charge our investors anything. We make our money through building and selling houses. So it's all about having a consultation with you, learning about your goals, seeing if this makes sense, and adding value and sharing
Mhm.
resources.
Awesome. Good deal. Well, Zach, it's always good catching up with you, buddy. I'm glad to hear that you guys are kicking butt and taking names. And we'll have to not make it 2 years until the next time that we have a conversation. So, but with that, my friend, best success to all of that you're doing. And always fun having you on the show. So good catching up with you.
Thank you so much, Kevin.
All right. Take care.